We have summarized the highlights of the 27th period into 4 points. During the period, we were able to implement initiatives which will lead to future growth. I will begin by explaining an overview of financial results for the 27th period. As the result of recording a gain on sales of real estate of 1,938 million yen in the 26th period, revenue increased temporarily. However, in the 27th period, the extraordinary gain on sales of real estate disappeared, so revenue and profit decreased compared to the 26th period. On the other hand, in November of the 27th period, we increased capital through a public offering. We used the procured funds to acquire 3 new properties, as well as to continue the internal growth of existing properties. Due to these factors, operating revenue was 8,569 million yen, and net income was 3,388 million yen in the 27th period. Due to the issuance of new investment units, the number of investment units increased by approximately 8.6%. However, by allocating 98 million yen of the reserve for reduction entry, which we had accumulated to unit holders, we kept the distribution per unit for the 27th period at 1,955 yen, in line with the revised forecast. In the current 28th period, ending in June 2020, revenue and profit will increase due to internal growth in the existing portfolio and full-period revenue contribution from the 3 newly acquired properties. We forecast a distribution per unit of 2,030 yen, up 3.8% from the 27th period. We have continued to steadily grow our distribution per unit since the sponsor change in April 2015. We have increased distribution per unit by 64.1% over the past 5 years. We will continue to aim for solid growth in the future. In addition, we have built up about 1 billion yen, equal to 559 yen per unit, of retained earnings even after the recent reversal. This will help stabilize future distributions. Next, I will explain the increase in capital via public offering in the 27th period. We issued 141,000 new units, including third-party allotment. Through the public offering, we procured 15.1 billion yen in funds. We combined these funds with 11 billion yen in new borrowings and with cash reserves in order to acquire 3 properties for 27 billion yen. We were able to acquire all 3 of the properties through exclusively negotiated transactions. The average NOI yield for the appraisal value basis of the 3 properties was 4.5%, and the NOI yield after depreciation was 4.0%. All of the properties were acquired in accordance with our acquisition policy, with strong focus on location, quality, and profitability. Furthermore, all the properties have upside potential. This can be done by closing the rent gap of the Osaka YM building, increasing the occupancy rate of East Square Tokyo, and increasing ADR for the Hotel Vista Premio Tokyo. From among the 3 properties, actions for increasing the value of the Osaka YM building are the first to achieve success. The Osaka YM building is located close to the Omeda area, where redevelopment is underway. We decided to acquire the property after confirming the large gap between the rent paid by current tenants and the market rent. By chance, we received an unexpected notice of cancellation from a large tenant. When combined with other tenants who are scheduled to vacate, 36.1% of the entire building will become vacant. Already, we are close to backfilling 26.5% of the building at rents about 83% higher than previous tenants, driving up NOI substantially. To continue, I'll explain the leasing status of our portfolio. The occupancy rate in the 27th period was 98.6%, which is a decrease compared to the previous period. However, we continue to maintain a high portfolio occupancy rate. The number of upward rent revision was 27, a high level that continued from the previous period. The rent gap, which is an indicator of achieving internal growth in the future, was minus 4.7% in the Tokyo area, minus 8.6% in the Osaka area, and minus 6.4% for our entire portfolio. The rent gap in all of these areas has increased compared to the previous year. We will work to further revise the rent of our tenants and improve NOI in the future. Next, I will discuss our financial base. Our credit rating from JCR was upgraded to AA- in March of last year. In the 27th period, we were notified by R&I that our rating was further upgraded to single A+. Our average remaining years of debts at the end of the 27th period was 4.3 years, and our average interest rate of debts was 0.95%. Due to factors such as an increase in the appraisal value LTV decreased, and our debt capacity grew even further. We are continuing to actively engage in ESG initiative and have won high marks in J-REITs. For GRESB, we acquired the highest Green Star for the 4th consecutive year and achieved the highest rating of 5 stars for 2 consecutive years. Furthermore, of the 9 J-REITs included in the MSCI Japan ESG Select Leaders Index, we are the only one to receive the highest AA ESG rating. In terms of CASB evaluation for the 27th period, we were the first J-REIT to acquire CASB for Smart Wellness Office certification. As a member of Mitsubishi Corporation UBS Realty Incorporated, MCUBS MidCity will continue our efforts in investment assets aiming to increase unit holder value. We look forward to continued guidance and support from our investors.